Hello, welcome to our BYOB Become Your Own Bank event. We're excited to have you here as you're coming in. Please let us know where you're tuning in from. Like, comment, share, tag anyone that you think would like to learn how to become your own bank. We're talking creating lasting generational wealth, building your wealth, growing your wealth, leveraging your wealth, cloning your money, becoming your own bank and having total control over your financial future. So please make sure that you grab a pen, a piece of paper, something to write on. You definitely want to take notes, okay? And ask questions as you're coming in. Let us know where you're tuning in from. Put your questions in the comments. We'll do our best to answer them live today. Yep. If by some chance we don't get to your questions, we will after. Okay, so put them in. And also, at the end of the event, we have a gift for you, a free gift. And we're also going to show you the next step you can take to get more and actually implement what you're going to learn today in the event in your own financial house. Okay, so we're Martin and Chelsea Matthews. Welcome. I'll tell you, if you don't already know who we are, in a minute, I'll tell you a little bit more about who we are, why we're qualified to even talk about this. But before we get started, really quickly, I'm going to tune in myself and I'm going to share, and I would like you to do the same thing because let me tell you,
My Millionaire Dynasty on Instagram. Hello.
The information that we're going to share with you today is not widely known. And most people, when they learn these strategies and these tools, are like, oh my God, why isn't everyone doing this? Because not everyone knows about it. And we're going to talk a little bit about why as well. And this information that we're going to share with you, this has changed our lives and it's changed our business. And it wasn't like we just learned it right away and started implementing it. This is information that we've learned over the years as financial professionals, licensed financial professionals, that we have learned and implemented over the years into our life, our clients' life, and our whole goal is to make learning about money fun and easy. Okay, so how many times have you learned about money and thought, oh, this is so fun? Usually not. And so our goal is to make it simple, easy, fun, and something that you're excited to do, and it's easy to implement. Okay, so be sure to.
What's up, Patrice? Patrice Stafford.
Hey, Patrice.
What's up, Tabitha? Logan, Rain.
What's up, everyone? All right, so thank you for tuning in. Let's get started.
And by the way, it's not because we're super smart. It's not because we're smarter than everybody.
He actually is a genius.
It's not because we're
he
smarter
doesn't like
than
me to
everybody.
tell you guys, but he does have a genius IQ. I'm just along for the ride. I'm riding on his coattails, okay, of smartness. I'm hoping it'll rub off on me. Okay, anyways, before he takes that to an inappropriate place, let's get started. Do we have the slides? Okay, how to become your own bank. Martin and Chelsea Matthews. That's what we're going to show you today. That's what you showed up for, right? You want to learn how to become your own bank and take back control of your money and your financial future. Now listen, Martin and I, we didn't always used to be on the same page financially. In fact, we didn't even always be in business together. Currently, well, this is actually a few years old. Our son is 16 now. But this is our family, Martin, me, and our son, William, who is 16 now. And we're lucky to get a recent picture.
Yeah, you don't take
Teenagers
photos no
don't really like a lot of pictures. So we do need to have an updated picture. But anyways, we were not always a family. We were not always in business together. In fact, before I met Martin, I was a single mom for 7 years. And I really struggled to find a balance between having family success and having financial success. And I felt like I couldn't figure out how to do them both. I was either spending time with William and freaking broke, or I was making money and not spending any time with William. And it sucked, and I felt guilty either way. And so I knew that if I wanted to teach him a better example of how not to struggle and how to create success and create the life you truly want to live, I had to figure some things out so I could teach him. And so I set out on a journey. I read books. I went to seminars. And eventually I met a group of financial advisors, and they were teaching people how money works, and they were making money doing it. And I was like, yes, this is it. This is what I want to do. So I moved, William and I, from Las Vegas to San Diego, and this is where I met this guy. He was also working with this group of financial advisors, and we met. And he was like such a nice guy that he's like, oh, I'll take you under my wing and show you the ropes, because he was like already in the financial industry. So I thought he was like just this nice guy trying to help out.
Nice guy, she means a dirty old man.
Yeah, he is a dirty old man, even though he's younger than me. Anyways, so when we got to know each other and he started like teaching me what he was already learning and implementing, then we realized that the goals that we had, the successful goals that we had, the impact that we wanted to make in helping people and impacting the world, it was so aligned that we decided to combine our business and combine our family and our life. And so now we are getting to create the life that we want to live while helping others to do the same thing. And so I'll tell you a little bit about us.
Yeah, because I mean, it's better for people to see you than just a picture on a slide. So I just switched you back over.
Okay. Yes, so now we'll get to some numbers so that we can show you that we're actually qualified to talk about this stuff. We're not just financial gurus. We're not just, people giving you our opinion. No, we are actually licensed financial professionals running a business. We have financial clients, and we help them with these strategies. And so
hey, Rain, someone on our Instagram feed said he couldn't get into the link. So I don't know if you want to check on that. Drop on our Facebook link. So if you wouldn't mind checking on them for us, thanks.
All right. So if you don't already know who we are, we're Martin and Chelsea Matthews. We're founders of M Wealth Group. We have clients in 48 states. It says 47, but we need to update that. It's 48 states. We have a combined 21 years experience. And we lead an agency of associate advisors. We've held multiple licenses in the fields of investment advisory, securities, and insurance. We're also co-authors of this book, Let's Fight About Money. We help couples communicate about money, handle conflict, and build an unbreakable financial house. So we help individuals and businesses properly use cash flow to create personal wealth. And our mission is to deliver measurable results to help our clients build an unbreakable financial house and business so they can live life by design. So you've heard me mention unbreakable financial house a couple of times. And what that means is that you can handle anything that comes your way financially. Your finances are unbreakable, unshakable, no matter what happens. But beyond that, it's not just about being able to pay your bills. It's about being able to create the life you truly want to live, share your gifts and talents that you were designed with, make the impact that you want to make in your own life, your family, your community, and beyond. However big that you can imagine the impact you want to make. That takes money, man. And so it's about strengthening your financial house. There's always another level. And when we talk about financial house, everyone's building a financial house. Everyone has a financial house, whether you realize it or not. Some people have a financial shack and some people have a financial mansion. And it's about understanding where you are, where you want to be, and then getting the right steps and actions to get there. All right. So as we're going through this event, we're going to deliver the information in a particular way. Knowledge, responsibility, and control. What that means, I said, we're not financial gurus. We're not saying our opinions, okay? We're telling you successful tools and strategies and actions that we've implemented in our life and our clients' lives, okay? So we're going to help you increase your knowledge so that you could take more responsibility in your finances, in your life, in your actions. And when you do that, you have more control. You have more control over your money, your actions, your results, all of it. Okay, we're not just going to tell you, listen to what we say because we're so smart. No, we want to increase your knowledge so you could take more responsibility and have more control. And now going back to the 6 building blocks to an unbreakable financial house. Well, I haven't said 6 building blocks, but going back to your financial house, what we've discovered that makes your financial house, there's 6 areas. We call it the 6 building blocks to an unbreakable financial house. So I'll tell you what they are really quickly. I'll tell you the 2 that we're going to focus on today. And then Martin Matthews is going to take it away with his genius expertise.
So for context, all of this is set up so you got a full understanding, and then we'll dive deeper into what are the exact steps to become your own bank? What are the problems that solves? Why do people use it? Who are some of the people who use it? What do they use it for? How is it used? All those different things. And if there's any questions along the way, feel free to ask. I know Jay Hemphill had a question on there. Well, stay tuned, Jay. We'll get to that question at the appropriate part. So stay tuned. We'll get to that in a little bit here.
All right. So these are the 6 building blocks that make up your financial house. Building block number 1 is cash flow, the money coming in and out of your household. Debt management, understanding good versus bad debt and using good debt to build wealth. Reserves is building up a reserves so that no matter what happens, you can continue on. If you lose a job, you get sick, you get hurt, the world shuts down, right? Proper protection is building block number 4, having the right kinds and amounts of insurance, specifically life insurance. Building block number 5 is build wealth. We all want to build wealth.
Do that again.
Build wealth.
Okay.
We all want to build wealth. We all want it to grow. We want to get it up and keep it up. And build legacy is building block number 6. That is having the right documents in place so that you actually can have the legacy that you want to continue on after you.
That's our motto. Get it up and keep it up. I think that's also Viagra's motto.
Probably. Well, that's why we say Viagra for your money.
Yes.
We'll teach you.
There you go.
Okay, no pills needed. So today, these are the 2 building blocks that we are going to focus on: proper protection and build wealth. And when you implement these strategies properly, it affects all the building blocks in your financial house to make it stronger and go towards unbreakable. Unbreakable. Okay, Mr. Matthews, take it away. Wow us with your
She likes to put the pressure on me.
Well, I mean, it's not really pressure when you're that good.
Thank you, sweetheart. Thank you. So look, guys. So we'll dive into my part on this. She also was helping to set up the context in which we deliver this stuff. In order for you to understand, she's the fluffer, apparently. In order for you to understand,
I'll tell you what is rubbing off on me from him is his dirty, inappropriate jokes. Actually, I do think them. I just don't say them out loud. But
she thinks them, but she doesn't say them out loud. Great.
Mm-hmm.
So
but now I do. So
So look, hey Joe, good to see you, buddy. Hey Patrice. So look, there's any financial tool or strategy or concept exists because there's a problem it's intending to solve. If there's not a problem, there's no use for that tool, right? If nobody needs to hang anything up, there's no use for a hammer. So I want you to understand, financial instruments are just tools. They're tools to assist you in getting the things you want in life, whatever those things are, whatever it is. On this planet, you need money. That allows you to get the things you want in life. So the more resources you can have and control, the more of that you have. So this is just a strategy that assists people to get what they want in life. It's one of many different things that they can do, but it solves a problem. So I'm going to go into that, and we're going to talk about what are the problems that people have, and then we'll talk about exactly what are the steps a person takes. But first, you got to understand, what is it solving? Why do these strategies exist? Why did they come about in the first place, and what are people trying to do? So make sure this is being shared here. 1 second.
So be sure that you guys have something to write with and take notes. Write down your questions. Put your questions in the comments. Like I said, we'll do our best to get them answered today live. But if we don't get to them today, we'll definitely follow up and answer your questions.
So look, when it comes to building wealth, there's a big problem. You're not being educated about the enemies of your wealth. Anytime you're trying to do something, you need to know what the pitfalls will be so that you can avoid them. So much of success in life is just avoiding the negative things that could happen along the way, whether it's with your money, whether it's getting the wrong spouse, whether it's whatever.
Why are you looking at me?
So you got to understand, avoiding those mistakes that can set you back or set you down. Look, there's lots of people who hooked up with the wrong person, had a child, and now they're stuck with that person and never wanted to be stuck with. I'm just keeping it real. You got to understand the pitfalls in life so that you don't make mistakes as you're going along. You also want to understand the enemies of your wealth so that you can handle them, so that you can handle them properly. So the three biggest enemies of your wealth, there's several of them, but the three biggest ones are: number one, taxes. Taxes, your largest expense is your taxes. It's the largest bill you pay. You pay it in all kinds of different ways. You pay when you buy gas, you pay when you get paid, you pay when you buy stuff, you pay it on all kinds of different things. You pay when you pay your phone bill, all of these things. Taxes is the number one enemy of your wealth. So you have to understand how to handle taxes. Second enemy of wealth, inflation. We've been talking about this for a long time. Inflation, basically, the result is the cost of goods and services going up. So when you go to the grocery store, it costs more. When you go to buy gas, it costs more.
Oh my God.
When the government inflates the money supply, prices rise up to match the new money that's been entered.
And it's not a high class problem.
Yes, everybody faces it, especially the poor and middle class feel inflation the most. Number three is market losses. Whichever market you're in, market losses. So those are the three biggest enemies of your wealth. Now, over the course of this webinar, before we're done here, we'll go over a strategy that the wealthy banks, big companies use to defeat these three enemies. So we call this strategy become your own bank because it leads to clarity, certainty, and control in getting what you want. You don't want any financial game plan to be fuzzy. You want it to be clear. You want to be certain about, okay, this is what I'm doing. This is a game plan I'm running, and I know what it's going to do for me. And I want to be in control of my money and how I use it. Okay. And I'll show you some examples and some stories that we'll share with you on that. So to understand how to do that, you first got to think about it the right way. Once you understand how to think about certain things, you increase your knowledge and your ability to solve your own problems because now you know how to think about something properly. So one of the biggest things you can ever do is to understand how to think about a problem so that you can become your own solution, so that you be empowered to know exactly what to do, not have to wait for somebody else to tell you how to handle this or how to handle that. When you become empowered, nobody can take that away from you. When I came to America from Liberia, West Africa, I didn't know anything about money. But when I learned, I got empowered, then I could make better decisions with my money. I could do smarter things with it. And then we got into this industry and then sharing that with people, right? So nobody can take away from you what you put up here, what you learn. No one can steal that from you. So there's three ways to view money. You can view money as a spender, which means you collect money, you spend it. You get it, you spend it. You get it, you spend it. And then there's very little left over. Then you can view money as a saver. Okay, I'm collecting money, I need to save it. I collect money, I gotta save it. Collect money, I gotta save it. And then you can view money as a banker. Well, what does a banker do? We'll talk about that here in a second. How does a banker view money? Banker view money as working. Banker always want to have money working because the banker never keeps money sitting in the bank. They keep it in motion because the banker understands about earning interest. We'll talk about that here. So spender views money as a way to buy stuff. Every purchase he buys costs him interest. Every purchase he buys costs him interest. Now, a lot of people will say, well, what if I pay cash? Well, whenever a spender borrows money, a lot of people they like fancy cars, so they go and borrow money to buy fancy cars. Well, when he borrows money, he pays interest. Other people will say, well, I should pay cash for everything. Well, when you pay cash, what else do you give up? You give up the interest that cash would have been earning for you, right? So there's a solution to be able to do both. How do I buy the things I want to buy and still have my cash working and compounding for me? This is the right question to think with. How do I do both? Not how do I just save money? How do I just pay cash for everything? How do you do both? How do you keep your money growing and use it at the same time? So I'll give you an example. We're talking about cars here in a second. But let's say the spender he finds a $30,000 car. Every 5 years, he's going to buy a new car for 30 grand, right? If he spends 5.5% in interest, after 11 purchases, the person who borrowed money has spent $378,000. So a lot of people say, wow, I've spent more in interest. I spent a lot of money in interest, so I should just pay cash. So the cash buyer, even if he goes and pays cash Every time he wants to buy a car for 30 grand, he saves his money, pays cash. He spends $330,000. So he actually spends less because he does save the interest. So it is correct. The spender, if he pays cash, will save on interest. So this makes people think it's always best to pay cash. They're like, well, I'll spend less money, so it's best to pay cash. So what the saver does is the saver first saves up money, and then they go to pay cash for their stuff. So I'm going to save the money, I got to pay cash for stuff, right? But the banker knows something else to be true. What else is true between a spender and a saver? The cash buyer, the person who pays cash for everything, and the one who borrows money, they both end up back at zero. They both end up back at zero. What do I mean by that? When you spend, you have money built up and you use it, it's gone. You're now back at zero. When you borrow money, you go into debt, you go backwards. And what are you trying to do? You're trying to get out of debt, which means zero. So both the cash buyer and the person who borrowed both end up back as zero. One guy uses all his money, now he's got to save it back up. Another guy goes into debt, now he's got to get out of debt. See, they both end up back at zero. So the banker understands that it's more important, earning interest is more important than paying interest. People always ask one side of the question, right? They're like, oh, what's the interest? What's the interest? What's the interest? What's the interest they're going to pay? Whenever they're buying something, what's the interest they're going to pay? Very rarely do they also say, what interest am I earning that would allow me to keep my money working and pay for this stuff at the same time? What if I could earn greater interest than what I'm paying in interest? Then would it make sense for me to borrow? They don't usually ask this question. They always tend to ask, how much is the interest rate on this thing? Because they're generally just thinking about spending or paying money. You got to also look at the other side of the coin. So the banker always wants to keep the money working. If you go to a bank, they don't have any money in the vault. They don't have money sitting there in the vault just rotting away. The bank has to put it to use. Lending money to you, me, your sister, your brother, all your mom, your dad, they'd like to keep the money working. So this thought process is why billionaires who can easily pay cash often get mortgages. They do not pay cash for their stuff, even though they're a billionaire. Why? Here's an example of this. Beyonce, Jay-Z, billionaires, got a mortgage. A lot of these billionaires have massive mortgages. So why do they do that? Because they understand having their money working in one location and leveraging that to have money work in a different location is senior than just the mortgage that they're paying. So they borrow a lot of money to buy properties. They don't pay cash for their stuff. Here's another person who does this, Mark Zuckerberg. So you guys watching on Facebook, Mark Zuckerberg, he has a mortgage. Why does a billionaire need a loan? This is on CNBC. It's very simple. It actually took a few years ago, Mark Zuckerberg refinanced his mortgage on his home. It would have taken him less time to simply write a check. Just, hey, here's a check, go pay cash for the house. Why did Mark Zuckerberg take the time to go fill out the mortgage paperwork to refinance a property? He already had a mortgage. He goes to refinance it. Why does a billionaire take the time to do all of that? Because he understands his money earning him interest in Facebook stock or earning interest in other places makes sense to leave that at work than to sell it off, take some of it, and go pay cash for a house. Now the money is sitting in a house. So Mark Zuckerberg, all these billionaires have mortgages. Even a great Warren Buffett. People always talk about Warren Buffett lives in his first house he bought, all that. Warren Buffett's bought more than one house since the first house, okay, guys? He was one time the richest man in America. So even Warren Buffett borrows money to buy real estate. Why does he do that? Because he's like, I'm not going to sell my company's shares. I'm going to keep my asset appreciating, and I'm going to leverage so that I can buy this real estate. So he borrows money for that. So I've got a question for you. It's an important question, and you always want to be thinking about good questions that make you think about money and finances. So this question is this. If your money is earning 4%, would it make sense for you to borrow money at 6%? Your money's earning 4%. Your money's compounding. It's earning 4%. Would it make sense for you to borrow money at 6%? So I always pause here. There's a little bit of a communication lag when we ask this question between when I say it and when you guys hear it. So I'll give it maybe 30 seconds or so. I want you guys to let me know what you think about this. This question is a very important question because once you understand the impact of this question, your financial decisions will be looked at very differently. So if your money's earning 4%, would it make sense to borrow money at 6%? What do you guys say? What would be your answer? Um, and one thing here is, excuse me, you got to think about some of the stuff that you're also even pay attention to what you're thinking about as I'm saying some of this information. What's going through your mind? Write down some of those thoughts. What are you thinking about? What are you learning? What are you picking up? Said, would it make sense? Patrice says, yes, if you're 4% is compounding. Jay Hempa says, you're paying back at a higher amount that you're making.
He says you're partying back.
You're partying back. Jay's ready to party. So Instagram, what do you guys say on YouTube? What do you guys think? If your money is earning 4%, would it make sense to borrow money at 6%? So let's look at it. Always look at it to see. Let's take the example that we're still on like a car, right? $30,000 car. Let's say this person goes and go to finance a car, because that's the decision people are going to have to make. Somebody may have money in an account earning 4%. This is just whatever. There's no special. It's just a random number, a magic account that's paying 4%. And let's say they got money in here. The question they have to ask themselves: I want to buy this car. They go to the bank. Bank says, "Oh yeah, we'll give you a loan for 30 grand at 6%." The person goes, "Oh, my money's earning me 4%. Do I want to borrow at 6%?" That's the question they have to answer for themselves. Let's look at it. So you go to the bank, get a $30,000 loan for a car, paying 6%. Your monthly car payment would be $580 over a 5-year period. The total you're going to pay is $34,799. Now, if a person believes that it's better, they're better off paying cash for everything, they're going to say, I don't want to pay $34,000. I don't want to pay $4,799 in interest. I want to pay cash. I'm going to pay $30,000 on cash, and they'll take a picture on Instagram or YouTube. Well, they'll take a picture on Facebook, not YouTube, but they'll take a picture on Facebook and say, I pay cash for this car. Awesome. Everybody claps for them. Now, here's a look at the other side of the coin. $30,000 compounding at 4% over 60 months ends up being $36,630. If this person would have financed the car there and kept their money compounding, even though it's compounding at 4%, and the interest they're paying to the bank is at 6%, they would have ended up with more money in their account. It would have actually made sense for this person to borrow. So people get lost in the 6% and 4%. They get lost in just that number. They don't do the math on money compounding. Compounding means your money keeps building on top of itself. The interest I earned last year gets added to my money. It goes to earn more interest next year. It goes to earn more interest the year after that. So you got to think your money's building and building and building. When your money is compounding, you don't want to interrupt it. You want it to just keep compounding for as long as possible, forever. I've got accounts that's compounding that'll never stop compounding until I die. That is the only point it will stop compounding, when I die. Because when I die, it would trigger a payment to her over here. So I have accounts that compound. I want you to understand that the money is going to keep compounding until I die. It's never going to stop compounding. Now, that's one of the things that we use as our own bank. So we're going to talk about that. So every purchase costs us interest. So as you can see, you either pay up interest or you give up the interest that you would have earned had you not done that. So what if we could use our money without giving up the interest we could earn? How can I keep my money working for me and buy the car at the same time? You have to think in terms of both. Everybody thinks linear. Everybody thinks, oh, I either got to pay cash or I got to borrow the money. How can I do both? How can I keep my money compounding and buy the car at the same time? This is what even Elon Musk. This is all these guys that do the same thing. They keep their money working and they leverage it for things they need to do. So becoming your own bank, there are a couple of steps you take. Number one, you got to create a pool of money, meaning you got to put money into a vehicle. That's a pool of money. You put money into a vehicle. We'll talk about what vehicles you use for that. You put that money to work earning compound interest. So as you can see, compound interest is extremely powerful. Is what makes 4% earning interest compounding at 4% is greater than if you were paying down a loan at 6%. So you can see that. And then you use that pool of money as collateral when you need funds. So let's say I want to buy a car. I need funds to buy a car. I need funds to make, I want to buy real estate. I want to do other things. I can use that money as collateral and keep my money working at the same time. Does that make sense so far? I'm checking with you. Make sure that makes sense so far. What's up, Bethany Rucker? Let me know if that makes sense. Drop in the comments if you're following, if that makes sense, those 3 steps. Now, to build your own bank, here's what we use. Because you got to store your money somewhere. We use properly designed life insurance policies that build cash. So I'll pause here for a second. There's 2 main categories of life insurance. There's one called term life insurance, and there's some called permanent life insurance. Term life insurance is generally there for you're going along in life, you die. Money pays to your family, right? Term life insurance typically provides you coverage for about 30 years. And something's got to happen to you before that triggers a payment. So now there's some term policies that can pay while you're still living if you got critically or chronically sick. We talked about that in some other videos, why you definitely want to make sure you have a policy, even if it's a term policy, that pays if you got critically or chronically sick, like you got cancer, stroke, heart attack, stuff like that. Then you have permanent life insurance. I want you to understand we own and use both. One's not better than the other. It's not a battle between the two. We own and use both. They're just financial tools. They serve different purposes. So we use permanent life insurance policies because permanent life insurance policies allow you to store cash inside of your life insurance policy. So here's why. Now, when I store cash in my life insurance policy, I don't suffer any losses, right? So the problem arises that I want to store money somewhere. I either can keep it in my bank account if I don't want it to get lost, but I'm going to lose due to inflation. So I got to figure out where can I put money where I can grow it beyond inflation and still not lose it. So suffer no losses. I have guarantees inside of it. I can earn compound interest, which means the interest that I earn gets added to the pool of money, and the next year it gets added and gets bigger and bigger. Remember I said I have one of my my policies was going to compound until I die, upon which it would trigger a tax-free death benefit payable to Chelsea. Did you want to say something?
Nope.
Okay, just sitting there looking pretty?
Yep.
Okay.
That's my job.
So it's your job to sit there and look pretty. All right, so earn compound interest. Liquidity, use, and control, which means I can get access to the money whenever I want. I can use it for whatever I want to use it for. I control that. So yesterday we had a client take a loan against his policy for something he wants to do. And literally it took, how long did it take on the phone with him?
It took longer just the phone ringing.
Yeah. So in 5 minutes, he was able to request a loan.
Yeah,
they don't ask a bunch of questions. You get a loan against his policy. Now he can go use that money for whatever he wants to use it for. So in 3 to 5 days, the money gets wired.
I would like a loan. What's the bank info? Okay, great. It'll be in your account 3 to 5 business days.
Yes.
Done.
So I want you to understand.
No qualifications, no ask, no questions asked.
Yeah, and it doesn't show up in your credit report because it's not based on your credit.
No, what are you using it for?
Yeah, none of that. So
Do
literally,
you have a job?
You can request a loan against your policy that quickly. So asset protection. Sorry, you're going to say something else?
No, I just said they don't even ask if you have a job, because like if you're trying to get, say, like a home equity line of credit, if you're not working, you cannot get a loan.
Yeah. So
we have a question.
Yes, you want to read the question?
Can you borrow more than you have started up in the pool, or does it have to be equal or less?
So I'll answer some questions along the way and we'll go back to the screen share, right? So it depends. So depending on the situation, by the way, we're going to show you guys some numbers. For those of you who want to see numbers for yourself, you can go to 6buildingblocks.com/bank. you can request to see numbers for your specific situation. 6buildingblocks.com/bank is where you can go to be able to request to see some numbers. I got a video on there where I do a scenario, where I show some examples, all that. But to answer your question, Patrice, so typically when you first put it in, so some people put in a lump sum of money. Like we have clients regularly who will say, hey, I've got 50 grand in my bank account. I want to fund it into the policy because it's just sitting in my bank account. I don't really need it right this second, but I want to be able to have access to it if I do need it. So they will drop 50 grand in a life insurance policy, and then to build their own, quote unquote, build their own bank. And then you can take 85% loan against that the next week, basically. Now, let me give you some caveats here. Your average life insurance person probably isn't doing this strategy, or may not know how to do it, or don't have clients like that who's using it for that way. It's a specialty. Somebody has to know how to do it. So if you're like, oh, I can maybe go to my bank or my life insurance person down the street, or I'm going to go look on Google and see, can somebody give me life insurance like this? No, they're going to give you a very basic life insurance policy, and they may not even know what the hell you're talking about. So understand, if you get some of the information from us, then you want to reach out to us so that we can help guide you on this process.
And even if somebody can design these type of strategies, they probably will design it wrong.
So it has to be, there's a lot of reasons why it's done that way. We do screen shares with people where we show them numbers and all that kind of stuff, because you have to, one, understand it. Right now we're just talking about the concept. Then you look at numbers, then you make a decision from there. But so that's in the first week, Patrice. That you can take up to 80, 85%, sometimes 90% loan against the policy, depending on how it's designed to be able to do that. We have clients who put money in there and use it for real estate. So they put money in there and borrow against it to buy real estate, flip a property, put the money back, turn around and use it again. Jay asked a similar question to that. The policy continues to grow and earn interest and compounds. So as it grows and earns interest and compounds, it gets more and more than what you put into it. And then, yes, then you'll be able to borrow more than what you put into it, because now your policy has grown. So the policy has earned more interest and has grown beyond what you put into it. So then you can borrow up to what's available in there. So eventually usually in a couple of years, it gets way beyond what you put in. So then it starts getting to be, but yeah, try not to get too complex here. But in the first, we can design a policy to where in your first 2 weeks of funding the policy, you can take 80 to 90% loan against it. All right. Okay. So back to the slide. Thanks. Good question, guys. Jay had a question where he said, what was that up there? You want to read the question?
You're partying back at a higher amount than you're making.
No, he asked something here in the beginning.
Well, I can't see it.
This question.
I can't remember who it was, but dude opened a life insurance policy, put $4 million in it, borrowed against it, and put that loaned money back into the insurance. What's that mean?
That means he used it like his own bank. Probably a high net worth person that put money. You don't have to put millions of dollars in it, by the way. You can fund it monthly. You can fund money into the policy monthly and then build it up and then borrow against it. So what the person likely did in that scenario was they used that policy like their own bank to store money. They're just, all it is a vehicle that's storing money inside of the vehicle. They have life insurance because they have a life insurance need, and they store money in the cash value side of the policy, and then they leverage that for other assets. So that person could have taken that money, put it into a multifamily deal, multifamily real estate, held it for 2 years, pulled the equity out, and paid the loan back, and still kept the multifamily. They pull the equity out and still keeping the multifamily after refinance. We have clients who do that all the time. So there's so many different ways to use it. All it is you're storing money out of a life insurance policy. It's not a more complex scenario than that. Once a person understands how it works and the problem is solved, then they can consider, does that make sense for them? We're just saying for us, and a lot of our clients, it makes sense for us. So we store money in life insurance policies, and we leverage it for income producing assets and other things. So we'll continue on. It's good questions, guys. If there's other questions, feel free to ask, and I'll do my best to answer. Answer. All right. Where's my thing? I'm getting hungry.
Me too.
All right. Okay. So liquidity, use, and control, asset protection. Money inside of my life insurance policy is protected. It protects me. I'm my greatest asset. So as life insurance protects me, but also I can store money inside of life insurance policy that can protect me in the case of lawsuits, all kinds of things like that. Tax free. So tax free is a lot of different ways. When I die, millions of dollars are going to be paid to Chelsea and to our trust tax free. Also, I can access the money inside of the policy on a tax-free basis through withdrawals and policy loans. Loans aren't taxed. So if I take a loan against my policy, there's no taxes. Elon Musk does this. So he takes loans against Tesla stock. Because look, when you sell the stock, you realize a gain. You don't have to pay taxes on that. So he takes loans against Tesla stock so that he doesn't have to pay taxes on that loan. Mark Zuckerberg gets a $1 a year salary from Facebook. He also takes loans against Facebook stock. All right. Collateral. I could use it as collateral for loans. I could take a loan through the insurance policy. I can take a loan other places. It can be collateral as an asset. Cash in my policy is an asset that can be used for other things. Disability benefits. Man, what if I'm building my wealth and boom, I become disabled? The policy can keep paying for itself. I can then actually get money from the policy also while I'm still living because I became disabled. The other thing is income for life, cash flow for life. Some of these policies have features where I can say, okay, now I just want to draw income of this for the rest of my life. I just send me. I want to check every month out of my policy. Rest of my life, I can live to be 120 years old, and you're still paying a check every month for the rest of my life. You can some of these policies will allow you to do that, where you can literally take income for life, and the income will not be taxed. So it can be used to fund my trust. Why? You give me some water to drink?
Well, you said you were hungry, so I never know what's the cutoff.
Okay.
So
so the policy I'm using to become my own bank, I use it to fund my trust, create generational wealth for my family. Bypasses probate. Probate is a process when somebody dies, they have to go to court and have to do all the stuff with their will, everything. The life insurance policy goes to whoever I want it to go to, and I also have a trust. So if Chelsea and I both pass away, that money is not going to go through probate. It's going to go straight into our trust for our son. There's instructions that we've left on how it's to be used, how it's to be dispersed to him, all of that. We use our life insurance policy to fund all those different things. So you can do the same thing for your family. You can set it up to where you have a trust, your life insurance policy that you're using as your bank can then go to fund your trust. And then that money can be dispersed to your family based on conditions you set. The trust can also buy real estate, and the real estate can pay cash flow to your family. So it takes care of them. There's so many different things you can use the strategies for. Let me erase that thing on the screen there, the link. Yeah, make sure you guys go to 6billionblocks.com/bank if you want to request some numbers to see some numbers for yourself when we end. Give me 1 second here.
You want me to grab you a shake?
No, I'm fine. I'll be okay. I shall be all right. Okay. All right, there we go. So this is a flow chart on how this is used for real estate. Oh, you can see the mouse. Okay, good. So first, a person funds a policy. Well, a properly designed policy. Again, caveat, not everybody understands how to design policies to use for your own bank. If it's not designed properly, it's not going to work that way. So it's got to be designed properly to be able to use for that function. We're using life insurance for its banking function. We're banking through life insurance. Another caveat, life insurance is not an investment. It's not an investment. It's life insurance, okay? You can't compare it to an investment. We compare it to a bank account for a very simple reason that it has features of like a long-term savings vehicle where the money's in there. Investments generally fluctuate or involves risk. The life insurance policy doesn't lose money, so it's not an investment. It is a life insurance policy. So we fund it as a store of our cash because one of the problems it solves is I need to earn a higher interest rate than inflation. I can't keep my money just sitting in a bank account because Chase will pay me 0.10%, and that's not going to do anything for me. So I'd rather put in life insurance policy and earn a greater interest rate and keep my money compounding and then use it for other assets like real estate. So I store money out of life insurance policy. I can you don't have to take a loan against it, by the way. You can just withdraw your money if you want. But again, if I withdraw my money, then it's no longer in there earning interest for me. So if it makes sense, I'm going to borrow against it. And I'm going to use it to buy real estate. The real estate cash flows, right? I can use the cash flow to pay down a loan on a policy. Or I can use the cash flow for my lifestyle. I can use the cash flow to improve the property. I can choose whatever I want to do with it. I can take multiple loans against the policy and buy multiple pieces of real estate, right? And you can design a policy in a way that even if you have a loan outstanding, there's a death benefit on the policy that when I die would pay out any outstanding loans, and the rest of the money will go to Miss Chelsea over here. Okay, so I'll show you. We talked about some of the other entities that use it. Banks actually buy a lot of life insurance. Again, life insurance is a place a lot of people store money. You have to have a life insurance need and you have to be able to qualify for life insurance, but it's a place people store money. So here it's called bank-owned life insurance, which means it's a life insurance policy that is owned by a bank. Not that the insurance company is owned by a bank, the life insurance policy is owned by a bank. Why do they do that? It says, although it may sound strange, bank-owned life insurance is a tax shelter for the bank and can also offer it a tax-free source of funds, right? It's a tax shelter. The bank also is looking for tax shelters. So the bank's looking for a tax shelter. Maybe you should be, thinking about it too. This is an interesting story here. Michigan, I think Georgia's going to play Michigan coming up here soon. Michigan, Jim Harbaugh, he's a football coach at the University of Michigan. He and the university agreed to increase compensation in the form of a life insurance loan. Whenever you see things like this, you got to ask, why was it done that way? Why would a guy take compensation in the form of a life insurance loan? So it says here, in addition to paying a $5 million salary for each of the remaining 6 years on his deal, Michigan will also loan Harbaugh $4 million in 2016. This was published in 2015 or 16. We'll also loan Jim Harbaugh $4 million in 2016 and an additional $2 million for the following 5 years to pay the premium on a life insurance policy. Why would a wealthy guy go out of a way to take a loan from the university and put it into a life insurance policy? Well, when you ask the right questions, it becomes very simple. It's because loans are not taxed. Jim Harbaugh was already receiving a $5 million salary, all right? $5 million salary means you're in the top tax bracket for the majority of your income. He didn't need more taxable income. He needed more non-taxable income. So he worked out a deal where instead of them giving him, look, his lifestyle probably fits into $5 million. So he's like, look, I don't need another $4 million in a paycheck. You give it to me as a loan, and I'll buy a life insurance policy with it. So he loaned him $4 million. He put into the policy, and he's going to put another $2 million a year for 5 years to buy a life insurance policy. And then when he dies, remember the money's going to compound. When he dies, that loan he received, the death benefit on the policy will pay off that loan for him, and he can draw income off of this when he retires. That's why he's doing it. So you don't have to put millions in there, but you can put a lot of money into it. The other thing is, regardless of your political views, the current president of the United States owns 6 of these policies. He's had them since the 1980s. He took them out in 1983 until his most recent filing. Biden has borrowed against the cash value of life insurance policies. Even the president of the United States, whether you like him or not, that's not my concern. I'm just telling you that he uses it. He borrows against it. 1983, that's almost 40 years. He's been using this strategy for almost 40 years, guys. And his loans against this policy is not taxed. Do with that what you will. Okay, so understand, even the president of the United States owns six life insurance policies that he's been borrowing against since 1983. All right. So you guys may not see this super clear, but this is an example. This is a scenario here. This I think was a 35-year-old person. The person's putting in $1,000 a month, so they're putting in 12 grand a year. They're funding this plan till age 70. At age 70, he'll have $1.3 million in there based on his $1,000 a month he's putting in. And he'll have a $1.6 million death benefit. You gonna say something?
No.
Okay. All right. And then this shows here if you want to use it sooner, a few years into the policy's already built up 100 grand. The person can take a loan against that whenever they want. So he can have his money working for him, take a loan against the policy, and use that to buy real estate, use that to buy other assets, different things like that. So another thing that we talk to people about is crypto. We don't talk to a lot of our clients about crypto. I put money into crypto myself because over the years, and particularly over the last few months, I've been doing a very deep dive into crypto and how people do well. A lot of people may know Dogecoin. And a lot of people are like, oh, crypto's going to go to the moon, and it goes down and they crash. There's ways to do crypto that you can do it. You can mitigate your risk, meaning you can minimize your downside and have a tremendous upside. So one of our clients actually used his life insurance policy to buy Bitcoin, and he had a 400% return in his Bitcoin, and then he sold some of it off to pay off the loan on his policy, and then he just kept the Bitcoin. He bought it at 4,000. He sold some of it off when Bitcoin went to 16,000, and he's held it. Today, Bitcoin is like 48 grand. It's going to go up. It was at 60 something thousand, and it went back down to 46. But imagine the client bought it at 4,000. He never needs to sell it. He can hold it forever. And there's ways to actually generate passive income off of crypto. So I won't get into too much of that today, but there's different ways a person can use their own bank for other assets, whether it's real estate, whether they want to use it for crypto, that's up to them. But you can use it for many different things. Okay. All right. So it was something you wanted to say, Chelsea?
Great job.
Thank you.
So, well, I will tell you guys what free gift we have. Actually, if you want to tell them first how they can get more and learn how to implement this strategy into your own financial house.
Okay. So as a recap, we talked about how you become your own bank. You're not going to go open. You're not going to go do a banking charter and open up your own bank on a street corner. That's not how people become their own bank. You leverage financial tools that already exist that allows you to use your bank, to use its banking function. So a bank is a financial institution that takes in deposits and makes loans. So that's the same thing we do with our life insurance policy. We make deposits into our life insurance policies and we take loans against it. So that's how we become our own bank. We're properly designed life insurance policies. Again, I will say this, it has to be properly designed and funded. Your average life insurance person, your average person you Google life insurance quote, they're not going to be able to set up a policy like this for you. This is a specialty. It's just like not everybody sells luxury real estate. If I'm trying to buy a $10 million penthouse, I'm not going to see the person who specializes in first time home buyers.
Or who just passed their license.
So it's different. It's just a different category. It doesn't mean you have to be super wealthy to do it, but you want to be financially in a position where you could. So it's a specialty that a person needs to know how to design it. You got to know which insurance companies to use. We have an insurance agency, so we use many, many different insurance companies that fits best for our clients. So we always evaluate what the client's needs are and help find what is the best thing for them. Sometimes the strategies, they're not ready to do a strategy like this, and we'll tell them, hey, we don't think you're ready to do this, so let's start with something else, and then we'll build up to this. It's not for everybody. Okay, so I want to make sure you understand that. But if you want to see numbers for yourself, and hey, I'm curious to see numbers for myself, how would this look for me? You can go to this site, 6buildingblocks.com/bank, and you can request an illustration. We'll put one together that's customized for you, and you can see what numbers will look like. Hey, if I'm using this as my own bank, how does it look like? How much will I be able to use? All that kind of stuff will be to help you see that, so you have a good understanding of it.
Yes. And our free gift to you today for joining us at our Become Your Own Bank event is you will get a free digital copy of our book, Let's Fight About Money. And this is good for couples or even people that are not in a relationship. There's a lot of valuable information in here to learn about communicating about money, and not just in a relationship, but in business, in all sorts of situations in life, you have to communicate about money. And so it's about confronting your beliefs, your habits, your mindset around money so that you can understand yourself as well as the people that you communicate and make financial decisions with. And we talk about teaching your kids good money habits, because that is so important. The things that we learn and implement, and we work so hard to take care of our family and leave something, leave a legacy, but we must also pass the information. Like, we're not just leaving our son a bunch of money. We have implemented and taught him the tools, the financial success tools, so that he can also implement these things and do well with what we have built and what we have left him, and to grow and build on it.
Yeah, absolutely. So
what are you laughing at?
Oh no, I was just thinking, because it's like some of the different things in crypto that we're learning. It's like I'm showing a lot of that to Chelsea, because look, something happens to me, she needs to be able to understand.
I gotta get in that wallet, man.
Yeah, she's gotta get in that wallet. So, and then if something happens to both of us and we leave a minor son, we've got to leave him enough resources to where he's not spoiled and not dependent, but still not leave him handicapped, not leave him in a position where he's got nothing to work with, right? So you got to do it in a way that empowers the person, not disempowers them. So we thank you guys for watching. Make sure to go to 6buildingblocks.com/bank. It's the number 6. So 6buildingblocks.com/bank. It's up there on your screen. And you can request a call from us or somebody on our team that would be helpful to you. So Bethany says, is there another book I can have that would add to the knowledge we learned from you both?
She said she already has the ebook.
Yeah. Thanks for getting the ebook. Chelsea and I are working on another book. A lot of people have told us, we need to do another book. We need to do something else. So we're going to be coming out with something that would be helpful, that would give people ways to increase their knowledge even more on these and how to build an unbreakable financial house. So we may do something around that topic. We'll publish something. We may do an ebook first and then publish a hardcover book, or do it like we did here. So we're going through that material to get that out. We'll put out more books, because we like putting the books together, and we have a lot of fun writing the book and talking about it. So that was great. Thank you guys for watching. Make sure to go to 6buildingblocks.com/bank if you would like to see some of these numbers for yourself. All right, guys.
And happy holidays.
Happy holidays. Hey, Cleopatra, Patrice, Tabitha, Bethany, Patrice. See you guys later. Thank you.
Bye.